Have you ever had that feeling that no matter what you learn in trading, as soon as you apply it to a real chart, everything falls apart? You hear the same words everywhere. BOS, MSS, FVG, order block, break block. You see them in posts, videos, threads. You think, okay, I got it, I'm going to use them. And then, you identify an order block. You trade it. It works once. Twice. And the third time, price slices through your zone like it's not even there. Stop loss. Account in the red. Stop everything. The problem is not you. The problem is that no one ever showed you the difference between a real signal and a trap. Today, I'm going to do exactly that. In this video, we're breaking down 5 fundamental ICT concepts, but not the usual way. No vague theory. I'm going to show you, for each concept, 2 examples. One fake, one valid. So you never confuse a false breakout with a real BOS again. So you never enter an FVG that isn't really one. So you know exactly when to click and when to sit on your hands. Here is the program. 1. The BOS. Break of structure. The foundation. And yet, so many traders misread it. I'll show you the difference between a valid BOS and a fake one. 2. MSS versus CHoCH. 2 signals that everyone mixes up. I'll give you the clear definition so you never doubt again. 3. FVG versus IFVG. The imbalance that the market loves to fill. But do you know when it becomes a trap? 4. The order block. The ICT trader's favorite. But a standalone OB is not enough. I'll show you the criteria that make it valid. 5. The break block. The misunderstood cousin. OB versus BB. Before versus after. I'll explain the difference. Every part is built the same way. A simple definition. A fake signal example. A valid signal example. And a short conclusion so you never get it wrong again. By the end of this video, you will have a mental checklist for each tool. And you will know exactly why one signal worked and why the other trapped you. Don't move. Grab a notebook. Let's start with the foundation. Let's start with the first tool, the most fundamental one. This is the simplest concept in the ICT family, but don't let that fool you. A lot of traders get this wrong. And that's exactly why they get trapped. So let's break it down properly. Simple definition. A BOS is when price breaks an old high or an old low with the body of the candle. Not with a wick, with the body. And a BOS indicates one thing, the trend continues. If we are in an uptrend, a valid BOS is when price breaks the old high with its body. The uptrend continues. If we are in a downtrend, a valid BOS is when price breaks the old low with its body. The downtrend continues. Simple, but there are traps. Let's look at them. Example 1. Fake versus valid. The body versus the wick. First trap, the classic one. Look at this candle. You see a long wick that pierces above the old high. At first glance, you think, price broke it. That's a BOS. I'm buying. Fake. Look at the body of the candle. It did not close above the high. It stayed below. This is a false boss, a fake breakout. Price just poked above to grab some stops and then came right back down. This is the classic liquidity sweep you now know about. Now, look at this other candle. The body of the candle closes cleanly above the old high. Not just a wick, the body. Price didn't just poke, it broke and stayed above. That is a valid boss. The structure is broken. The uptrend continues. Remember this rule. The body confirms, the wick traps. Example 2. Fake versus valid. The old major high versus the small high. Second trap, more sneaky. Look at this chart. Price just broke a high. You think, boss, I'm in. Fake. Look closely. That high that got broken, it's a small recent high, a local high, but it's not the old major high of the trend. The real significant high, the one that structures the entire trend, is further away, higher, and it hasn't been touched. Now, look at this situation. Price breaks the old major high, the one dominating the whole structure, the swing high that has defined the trend from the beginning. The body closes above it, cleanly. That is a valid boss. The major structure is broken. The trend continues with strength. Remember this rule. A BOS must break a major level, not a small local high. The level that everyone sees. Conclusion. Here is what you need to remember to always identify a valid BOS. You need two conditions. 1. The body of the candle must close beyond the old high or old low, not a wick, the body. 2. The broken level must be a major old high or old low and aligned with the trend, not some small insignificant high, the real swing high, the real swing low. If one of these two conditions is missing, you wait. Discipline. A fake BOS is a trap. A true BOS is confirmation that the trend continues. MSS versus CHoCH. After the BOS, let's move on to two concepts that create a lot of confusion: the MSS and the CHoCH. Some people use them as synonyms. That's a mistake. Today, I'm going to show you the difference, clearly, so you never confuse them again. Simple definition. MSS stands for Market Structure Shift. Imagine a downtrend. Price is making lower lows, lower highs. Then suddenly, a candle appears, a sudden displacement candle, violent momentum. This candle breaks the previous high of the downtrend. This is not a small poke, it's a clean break, with conviction. This signal is the MSS. The MSS announces one thing: the end of the internal trend. The current trend is losing steam. A deep retracement or a local reversal is coming. Remember this. The MSS breaks the last internal structure. It's the first warning. CHoCH stands for change of character. This is more powerful than the MSS, more rare, more decisive. Let's go back to our downtrend. Price doesn't just break a small local high, it completely changes its behavior. Before, it was making lower highs and lower lows. Now, it starts making higher highs and higher lows. The character of the market has changed. It's no longer bearish. It has become bullish. This signal is the CHoCH. The CHoCH announces one thing: the end of the major trend. The market has changed direction. It's no longer a retracement. It's a reversal. Remember this. The CHoCH is a complete structural change. Highs and lows invert. MSS versus CHoCH, the fundamental difference. Now let's summarize the difference. This is crucial. The MSS is an internal signal. It announces the end of an internal trend, of a small phase. It's the first domino to fall. Price breaks a local high or low. The trend slows down. A retracement is coming. The CHoCH is a major signal. It announces the end of the global trend. Price has completely changed character. Highs and lows have inverted. The market has chosen a new direction. How to use them together. These two signals don't oppose each other. They complement each other. Often, an MSS appears first. It warns you. It tells you, pay attention. The current trend is weakening. Be vigilant. Then later, a CHoCH forms. It confirms the market has changed direction. The new trend is in place. The MSS is the alert. The CHoCH is the confirmation. In trading, you can use the MSS to prepare, to exit a position, to avoid trading against the new move. And you use the CHoCH to enter the new trend, with conviction. Conclusion: MSS versus CHoCH. Here is what you need to remember. The MSS is a sudden break of the last internal structure. It announces the end of the internal trend. It's the warning signal. The CHoCH is a complete change of character. Highs and lows invert. It announces the end of the major trend. It's the confirmation signal. Never confuse them again. The MSS says, something is changing. The CHoCH says, everything has changed. FVG, fair value gap, versus IFVG. Let's continue with the third tool, the FVG, the fair value gap, or imbalance. This is one of the most powerful concepts in ICT, and the most visual one. Simple definition: an FVG is a hole in price. an empty space between three candles where price did not trade. Look at this space. Price moved up too fast. It left an imbalance, a zone where no one could trade. That is an FVG. The market hates imbalances. It loves to come back and fill these zones before continuing its move. An FVG is like a magnet. Price will want to return to it. Example 1. Fake versus valid. First point, not every FVG is valid. Fake. Sometimes, price leaves a gap, but it fills it immediately before continuing. The FVG existed, but it was closed too fast. This is not a tradable FVG. Valid. A real tradable FVG is a clean gap. Price goes up, leaves a hole, and continues its path without filling it immediately. This type of FVG acts like a magnet. In a trend, price often comes back to test it before continuing in the original direction. Remember this. If price fills the FVG too fast, it's not tradable. Wait for a real clean imbalance. Example 2. FVG versus IFVG. Now, let's talk about an advanced concept, the IFVG. IFVG stands for Inverse Fair Value Gap. It's an inverted FVG. Here is what happens. You have a bullish FVG. Price comes back to test it. Normally, it should bounce and continue higher. But instead, price crosses the FVG. It closes below it. The bullish FVG is broken. It becomes a bearish FVG, an IFVG. The magnet has inverted. Now, it's a resistance zone. Price might want to come back and test this zone from below. Classic FVG. You trade in the direction of the gap. Price returns to the zone and bounces. IFVG. The gap has been broken. It changes nature. It becomes an entry point in the opposite direction. Remember this. A crossed FVG becomes an IFVG. The zone inverts. Support becomes resistance. Resistance becomes support. Conclusion. Here is what you need to remember. A valid FVG is a small, clean imbalance in the heart of a trend. Price does not fill it immediately. It uses it later as a springboard. If the FVG is crossed without reaction, it becomes an IFVG. The nature of the zone changes. In both cases, never enter in the void. Wait for price to come back and test the zone. Wait for a reaction, a rejection, a confirmation. Let's move on to the fourth tool, the order block, the OB. This is the favorite tool of ICT traders, and for good reason. Simple definition. An order block is the last opposite candle before an impulsive move. Look at this red candle. It's the last bearish candle before the bullish explosion. This candle is the order block. It's the footprint of the institutional order, the place where the big players place their final sell orders before letting price fly. When price comes back to test this zone, it often reacts. It's a high probability entry point. But pay attention. A valid OB is not based on luck. It rests on two major criteria, a valid BOS, plus an FVG, all aligned with the market trend. If these three elements are present, you have a quality OB. Remember this. An OB with BOS plus FVG aligned with the trend is far more reliable than a standalone OB. Look for confluence. Breaker block BB versus order block OB. Fifth and final tool, the breaker block, the BB. This is the cousin of the order block, but with a different role. Simple definition. A breaker block is an old order block that has been broken. Look, price broke the OB. It went right through it. It went to grab the liquidity that was sitting behind it. Now, this old OB changes nature. It becomes a breaker block. If it was resistance before, now it's support. The old OB is dead. Long live the BB. OB versus BB, the fundamental difference. Never confuse these two tools again. They don't have the same function. The OB is a zone before the move. The OB is the zone where institutions place their orders before price takes off. You enter on the OB when price comes back to test it. You anticipate the breakout. The BB is a zone after the move. The BB is the old OB that has been broken and then retested. You enter on the BB when price has already broken through, already made its move, and comes back to find support on this old resistance. The OB equals before the explosion. The BB equals after the explosion. Remember this. The OB is your entry point before the move. The BB is your entry point after the move. Never anticipate. Wait for the test. A valid BB is an old OB that has been broken, then tested successfully. The rule is simple. For the OB, you want to see a BOS, an FVG, and alignment with the trend. You enter on the test of the OB before the explosion. For the BB, you want to see the OB first broken, then the external liquidity swept, then price coming back to test the old OB turned BB. You enter on the test of the BB after the explosion. 2 tools, 2 different entry moments. Never confuse them again. And there it is. BOS, MSS, FVG, order block, breaker block. 5 tools, 1 single philosophy. Never anticipate. Wait for confirmation. The market gives you everything you need right on the chart. No indicators, no magic formulas, just price. If this video helped you see these ICT concepts more clearly, drop a like. It supports the channel. Subscribe for what's coming next. We're going to keep digging deeper. And tell me in the comments which tool you use the most and which one you want me to dive deeper into in the next video. Trade with your eyes open. See you in the next one.